Hello students, welcome back to GK's Education. As we all know, partnership accounts is going on and we are doing retirement and death of partner. So in that case, in the previous videos, we did the treatment of goodwill in the case of retirement or death of partner. So today we are doing revaluation of assets and liabilities, the adjustments that are required for assets and liabilities at the time of retirement or death of a partner. Yes, I would like to request, if you're liking my videos, please do not forget to like and subscribe my channel. So let us come to the point. At the time of retirement or death of a partner, there may be some assets which may not have been shown at their current value. So, as in the case of admission of partner at the time of death or retirement, there may also be some assets which are not shown at their current value. Also, there may be some liabilities which have been shown at the value different from the obligation to be met by the firm. That means at that time the liabilities may not also be shown at the current value. So there also may be some unrecorded assets and unrecorded liabilities which need to be brought in the books. So it may also happen that there are some unrecorded assets or liabilities at that moment, so we also need to plot them into the book. So here, as same in the case of admission of a partner, a revaluation account is prepared. So as we did the revaluation account, the pro forma, the basic, at the time of admission of partners, same procedure is followed here, and the net gain or loss of revaluation is transferred to all partners, including the outgoing partners, in their old profit sharing ratio to all the partners. So we are not going to waste the time again revising this point of revaluation. You can watch my previous video of revaluation account on admission of partners. So the procedure, the pro forma, the entries, they are same. So what we will do, we will make it clear with the help of this example. The entries and the account will be same as the admission of partners. So we will do this example to make our point clear. Here in example, M, I and G are the partners sharing the profits in the ratio 5:3:2. On March 31st, their balance sheet was, so it is the balance sheet given, where goodwill, building, patents, machinery, stock, debtors and cash and sundry creditors 55,000, reserve fund, capital accounts. Yes, G retires on the above date and it was agreed machinery be valued at 1,40,000, patents at 40,000, buildings at 1,25,000. Now record the necessary entries and prepare the revaluation account. So let us check out here. First, the revaluation account. Like first entry was machinery was to be valued at 1,40,000. Earlier the machinery was 1,50,000. That means depreciation of machinery was there. So the first entry will be revaluation account to machinery. Here we will enter machinery on the debit side. And then second was patents to be valued at 40,000. Where were patents? Patents were earlier 30,000. So there is an appreciation in the case of patent. So patents will be debited in the entry, and here at the credit side patents will be there. And then buildings at 1,25,000. Earlier building was 1 lakh, so 25,000 appreciation. Here building will be debited in the entry, and here building will be on the credit side. Now yes, only these three entries were there. So now what will happen, we will balance the revaluation account, and the profit will be transferred to the old partners in their old profit sharing ratio, that is 5:3:2. So here balance is 25,000, which will be transferred to three partners. Okay, so the entry will be revaluation account debit 25,000 to M, to I, to G's capital in their old profit sharing ratio, and it is the revaluation account. Not any change in the revaluation account is there. So it will be same as it was as we did in the admission of partner. Same entries, same pro forma, same account. The another adjustment required is the adjustment of accumulated profits and losses. So it is also same. It may happen the balance sheet of the firm may show accumulated profits in the form of accumulated profits in the form of general reserve or the reserve fund, or accumulated losses in the form of profit and loss account. That is the debit balance. The retiring or deceased partner is also entitled to his share of accumulated profits and losses, as they all belong to all the partners and should be transferred to their capital accounts in the old profit sharing ratio. Means at the time of retirement, on the date of retirement or till the date of retirement or death of a partner, any accumulated profit or loss or any reserve that belong to all the partners and will be transferred to them in the old profit sharing ratio. So nothing is to be hiding out, or the outgoing partner have a complete right to get a share out of them at that time. So for the entries for that will be: for the transfer of accumulated profits, reserves account debit, as reserves are credit. So now when we are writing them off, the reserve will be debited to all partners capital account in the old profit sharing ratio. For the transfer of accumulated losses, like losses are always like losses, so at that time the all the partners capital account will be debited to profit and loss if there is a debit balance in the profit and loss account. Let us do one big example to make a point very much clear. Yes, here is the example. X, Y, and Z are the partners sharing in the ratio 2:2:1. On 31st March 19, the balance sheet was cash 30, BR, bills receivable, debtors, stock, furniture, plant and machinery, and building. Bills payable, sundry creditors, profit and loss account, and then capital accounts. Now, what will we do? On April 1, 2019, X retired as XYZ. X retired from the business, and then the assets and liabilities are revalued at: stock depreciated 10%, furniture depreciated by 20, plant and machinery by 5, building was appreciated by 20%, and the goodwill of the firm was valued 60,000. X was to be paid in cash 19,600 and balance in 3 equal installment. That we will do in the coming videos, that how the money disposed to the how the money is given to the outgoing partner. Now in this problem, prepare the revaluation account, partners capital account, X's loan account, and the balance sheet. Here when we don't have the sufficient fund to give to the outgoing partner, in that case we create that partner's loan account, which appears in the liability, which we are going to do. So check out the solution. Yes, the revaluation account. Now first, stock is depreciated by 10%. Stock was 40,000. Here stock is 40,000. So 40,000 into 10, that is 4,000. Now second adjustment is furniture depreciated by 20%. The furniture earlier was 80,000. So 80,000 into 20%, 16,000 furniture. And then plant and machinery by 5%. Plant and machinery here is 1,20,000. So plant and machinery on the debit side, 1,20,000 into 5%, 6,000. Now building was appreciated by 20%. Building is 2 lakh and appreciated by 20%, 40,000. Increase in the building. Now goodwill is a separate thing and not any other entry for the revaluation account, so we'll balance it. The balance will be 14,000. It will be divided among the 3 partners in the old profit sharing ratio. Now come up to the capital accounts of the partners. Now see how we do capital account of the partners. The balancing figures: 80, 80, 65. So here we will brought down the balance 80, 80 and 65. Then we will transfer the old reserves. Here creditors BP, they will not be transferred. The profit and loss account, the earlier debit balance of profit 75,000. So it will be divided in the old profit sharing ratio 75,000 by P&L reserve account 30, 30, 15 in their old profit sharing ratio, that is 2:1. And then the profit of a revaluation account will be transferred to them. So all these entries are there. And now the goodwill adjustment, how we will do the goodwill adjustment, let us check it out. Valuation of goodwill. As we all know, the old ratio is 2 is to 2 is to 1, and now X retires. So the gain ratio will be, as the new ratio is not given, we did it in the calculation of gain ratio. When the new ratio is not given, we consider the old ratio as the same ratio. So gain ratio is 2 is to 1. Now goodwill is 60,000. Goodwill 60,000 already given in the question. Goodwill is valued 60,000. So in the now goodwill 60,000. Now X share of goodwill is 60,000 into X share 2 upon 5, 24,000. This 24,000, this share of goodwill will be distributed among Y and Z in the gain ratio 2 is to 1. So Y's share will be 24,000 into 2 by 3, this ratio 16,000, and Z share 24,000 into 1 by 3, that is 8,000. Entry will be Y's capital account debit 16,000, Z's capital account debit 8,000 to X's capital account 24,000, and this entry will have its effects in the capital accounts. In the case of X's account, the entry will be X's account by Y's capital by Z's capital 16 and 8,000, this entry. And in X's capital in Y's and Z's capital account, for Y's capital, entry will be 2X's capital by 16,000, and in Z's capital it will be 2X's capital by 8,000. So this will be the basic effect of entry. Now all the entries done, we will do the balancing of the capital account. First we will add this up, X, the retiring partner's account. We will add this up, and the balancing figure, out of that we enter, as it is stated in the question, we will pay him 19,600 in cash. So out of the balancing figure we will pass the entry to cash 19,600, and the balancing figure we will create a loan 1,20,000 to X's loan 1,20,000. Now we will balance the Y's capital account, balancing figure 99,600, Z's account, balancing figure 74,800. Now come up to the balance sheet. First the loan account. Loan account by X's capital account 1,20,000, this balance. X's capital account to loan account, and on loan account by X's capital 1,20,000, and the balance will carry down as well, same 1,20,000. So come up to the balance sheet. This is a balance sheet of the question. Now check out item wise. Cash 30,000 minus 19,600 paid to the partner here, and bills receivable 9,000. Same. Then debtors 21,000, stock minus depreciation, and then furniture minus depreciation, plant and machinery minus depreciation, building plus appreciation. So it comes out to be 4,94,400. And on the liability side, let us check. Yes, bills payable same 98,000, sundry creditors 1,02,000, profit and loss we transferred, and here X's loan account liability will be created 1,20,000, and capital accounts balancing figures, and here is the balance sheet. So this is how we will completely do the treatment of accumulated profits and losses and the revaluation account. I hope the points are very much clear. Please go on liking and subscribing my channel. Thank you.